Hi, welcome to this episode of Industry Voice. Today we have a special group of guests today. We have Joseph Petrelli and Matthew Monson on the show. How you doing, gentlemen?
Doing well, Jeff. Thank you.
Very, very good, sir. Happy to be here.
So recently there was a pretty big news of KPMG moving into the legal space. And we thought that this was really worth covering and deep dive into because it's really not being talked about. So I thought, you know what? Let me bring some people on the show who know a little bit something about this industry. And Joe and Matt, if you guys can go ahead and introduce yourself and let the audience know who you are and what your background is, and then we go right into talking about this scenario. Joe, if you want to go first.
Sure. I'm Joe Petrelli. I'm an actuary by background. I'm president and founder of Demotech. We were actually the first company to review and rate smaller independent regional insurance companies. We did that in '89. I'll spare you the history and just say on July 11th of 2022, Demotech was registered with the United States Securities and Exchange Commission as a nationally recognized statistical rating organization in the class of insurance companies. There are but 10 NRSROs, AM Best, Standard & Poor's, Moody's, Demotech, and 6 others.
Yeah, and just for myself, Jeff, my name is Matthew Monson. As you stated, I'm the owner of the Monson law firm that represents insurance companies in Louisiana, Texas, and in Florida. We have approximately 20 lawyers that work at our group, and we've started. Actually, we're about to celebrate our 14th anniversary on February 1st. So again, thank you for having us on.
Congrats on the early anniversary.
Thank you.
So let's break down the news. Let's tell our audience when the news broke out, and then what do you guys foresee are the possible changes coming down the line and what the impact is.
Well, I'll start out with some of the overview and let Matthew fill in the details. In March of 2022, Demotech undertook research using Todd Kozakowski as the researcher. And what was discovered was that opportunists were using search engine optimization, litigation platforms, litigation marketing, and third-party litigation funding to try to secure claims online, to secure contested claims. And one of the cornerstones of that process was litigation funding or third-party litigation funding, whichever you prefer to call it. And what we have found since that point in time is not only the breadth and scope of that effort, but there is now the opportunity from the state of Arizona, the state of Utah, and the District of Columbia for non-lawyers to own law firms through what's called an alternate business structure. And the most advanced effort is probably in the state of Arizona. And the way they got there was to amend one of the important rules, Rule 5.4, for law firms and associations in the area of ethics. I'll take a break there. Matthew, if you wanted to spend a little time, or I could go on a little bit more detail, whatever you prefer.
Certainly. Thanks, Joe. Just real quick, the one of the things that we're seeing across the board in the legal field is hedge funds and private equity either lending money to law firms or trying to get to own law firms. And there's a multitude of ways that they do it, but the way that allows them the most flexibility is the Arizona alternate business model scenario. And what's ended up happening that people are looking at that and saying, hey, wait, we're not lawyers. But we want to own law firms and we want to control law firms and we want to handle all the legal issues ourselves. And so the best way that can do it really is Arizona. Washington, D.C. and Utah are also havens for this. But Arizona is allowing not only for the fee sharing with non-lawyers, but non-lawyer ownership in law firms, where you have people who aren't lawyers, who can't be disciplined as lawyers, actually owning law firms. And this causes a litany of challenges. The Rule 5.4, which is part of the rules of professional conduct for lawyers, actually prevents this. And it's and largely there to really protect the public, protect the people from unscrupulous scenarios. And that's the high level of concern, which has been highlighted by KPMG's announcement that they want to create one of these alternative business structures in Arizona.
I think what you have, Jeff, what is there is when you look at what Demotech and Forewarn call tech-enabled claim instigation, and Matthews alluded to how claim harvesting and the hedge funds, the private equity funds, there is between the search engine optimization, the litigation marketing, the techniques being used online, there's a great deal of collaboration between third parties that needs to take place. And then on top of that, you would supersede the funding, either through loans or investments. And and Matthew mentioned Rule 5.4, under that rule in its entirety, the collaboration between the parties to try to harvest and secure contested claims could be considered improper. So what's happened in Arizona is certain elements of Rule 5.4 have actually been deleted, and that way there is no longer that requirement. So now you have third parties who have no background in law, they have money, eliminating the friction and the middleman of interacting with these law firms, because they are now a shareholder or a partner or a stockholder in that law firm. I will just say this, and I'll turn it over to Matthew. My granddaughter has a beautician license, and she says to me, Grandpa, you mean if you want to own a beauty shop in a state, you have to be a beautician, but to own a law firm, you don't have to be a lawyer?
Right. No, that's a very good point, Joe. And one of the challenges in the claim space when we're talking about obtaining clients, this is first kind of being done in the mass tort world, and it's even being considered normal, where lead generators that are paid millions of dollars by law firms go out and obtain what they call sometimes pre-screened potential clients, right? And so what ends up happening is that a lead generator who is not bound by any attorney ethical rules whatsoever, they can go and obtain clients and cases without regard to the lawyer advertising rules. Then what those lead generators do is they sell those cases over to law firms. And a lot of times selling it in the terms of, hey, look, we already have a signed contract. We got somebody to sign a contract. We did the intake. We found these people, and we're going to sell you these people, sometimes with advance payments. So, for example, it's been documented with the case of the law firm McClenny Mosley and Associates. They're not an Arizona law firm, but there's an Arizona-based lead generator that sold them signed contracts for $3,500 each. This law firm was buying the contracts at 1,000 people in advance. So 1,000 times 3,500 was $3.5 million. We know from court pleadings that this firm paid almost $14 million in advance to have people just signed up. I actually received one of the text messages, and that's how they did it. This particular lead generator, which formerly went by the name of Velocity, they would send text message marketing to people. I received one of these. My wife received one of these, saying that you qualify for benefits after a storm. And so after Hurricane Ida, we both received these text messages, and it says here, click here. They take you to our website. The website does not even mention a law firm's name on it. They ask you for some information for you to put in there. And then next thing you know, somebody calls you from an out-of-country call center to sign you up to sign you up as a client. They then, while you're still on the phone with you, they will sit there and send you the signed contract, a contract for you to DocuSign. And so then once you've signed that, at that point, the law firm does not even know that you exist. Then the law firm would just have the signed contracts uploaded into their system, right? That is not a way to vet particular clients. It's not a way to give people the personal knowledge and personal handling that that the service that the legal industry is supposed to give. And that's just one small instance. It's just one law firm that's not even set up in Arizona. A lot of the law firms that are set up in Arizona already are advertising, hey, we can help you with the Maui wildfires, even though they have no lawyer on their website that has a Hawaii license. Because the idea is to obtain these clients through the tech-enabled marketing that Joe's mentioning, right? And once they obtain the clients, then to co-counsel or sell those files to other law firms all around the country. And those law firms that they're selling it to might not even realize that they are sharing fees with non-lawyers that violates Rule 5.4 in their state. And millions of dollars are being invested into this by hedge funds. In the example of McClenny Mosley and Associates, we know that $32 million was loaned to them by a hedge fund, interestingly called Equal Access Justice Fund. And so that's that's one of the main concerns. And they're just a couple of small players in this marketplace that's been estimated to be 15 or 20 billion dollars when it comes to the outside hedge funds investing in what I call litigation harvesting. Now I'm going to go on for a little bit, and so I apologize, but litigation harvesting is different than litigation financing. When we look at all the bills and the laws that have been passed in multiple states, including Louisiana, where I live, they define litigation financing very particularly. Litigation financing is defined as financing for a particular case, that the repayment of that is contingent upon the case being successful. What I've been identifying is massive investments in borrowing money and hedge funds being owed money that are not contingent upon a particular result. And because that's not the case, they are actually statutorily immune from disclosing that, right? And so they're so far ahead of what the efforts are in dealing with the third-party litigation financing. It's not even funny, and it's important that everybody knows.
Yeah, let me give you, Jeff, let me give you from the American Bar Association's website, Rule 5.4D. This is the part that has been deleted in Arizona. D says, 5.4D says that a lawyer shall not practice with or in the form of a professional corporation or association if the following: non-lawyer owns any interest, non-lawyer is a corporate officer, director or officer, or occupies a position of similar responsibility, and third, a non-lawyer has the right to direct or control the professional judgment of a lawyer. That's D3. A non-lawyer, you're not supposed to do anything if a non-lawyer has the right to direct or control the professional judgment of a lawyer. D1, 2, and 3 were deleted in Arizona, so they're no longer applicable. And now you have this influx of alternate business structures with billions of dollars of investment monies that are now directly owning non-lawyers and corporations owning parts of law firms. And there's actually a list. I'll just say the list is at azcourts.gov. You will find the Alternative Business Structures Directory. And I mean, this is not science fiction. This is all right there.
And I think what
So
Joe, I'm sorry, go ahead, Jeff.
I'm not on the website right now. Have you guys taken a look at how many alternative business are there that's on that list?
This is the list of approved, alternate business structures. There's approximately, I would say there's 40 to 60 that have been approved, and they're listed on the site in alphabetical order. And I think this list was just printed off today, and assuming that they tried to make the investment under their name, KPMG is not yet approved. They're not yet on that list as a licensee's name or under the business information. So I think what we saw in the public sector was that their application is in and that they're awaiting disposition, would be my hunch.
Right. And I think it's also, Joe touched on a very important point, when talking about Rule 5.4. And it's really important that lawyers have their professional independence preserved, right? Allowing non-lawyers to share fees or own law firms can compromise that attorney's professional independence, right? Non-lawyer stakeholders, they can prioritize profitability over that duty to provide zealous representation, and provide ethical legal advice. And so it's extremely important that a lawyer can come up with their own professional opinion without undue influence from somebody. And you can imagine a circumstance with a major consulting firm or accounting firm saying, "Hey, look, we've done everything here. We know you see some things that are of concern, but in order to keep this client happy, we need the legal people to sign off on this. And when, by the way, we're the ones giving you your paychecks quite directly, and we can hire and fire you, right?" And so it provides a very challenging space that the reason why this rule has been here for decades, right, is to protect lawyers from the people who are providing them money. Does it mean that it doesn't happen already in the world for clients, trying to influence their attorneys' behaviors? Of course it does. That's been around for a while. But this just takes it yet to another level to where, hey, look, if you want to keep your job, you better give us this legal opinion. And that's the main level of concern here.
I did. What jumped out at me with the headline, and again, given that the application appears to be pending, what jumped out at me being in the insurance industry is that obviously that accounting firm has a significant presence in the insurance industry. They have a significant presence with actuarial consulting, including loss and loss adjustment expense reserve opinions for carriers. And so the first thing that entered my mind was, what do you do if you're the auditor and somehow you're the legal firm and somehow your legal advice led to claims that your actuary opined on? So it just struck me that there could be just a confluence of situations where, given the global presence of KPMG, that their professional consultants might be kind of crawling all over each other, giving advice to the same entity.
Right. And Jay, you're exactly right. Non-lawyers also lack the same commitment to legal ethics, right? They're not bound by the legal ethical rules that are in place. So, this potentially creates conflicts between the business interests and the ethical obligations of attorneys, right? And and then when we look at some of the the behavior, particularly of KPMG, there's some things that are out there in the news that are quite telling, right? In 2005, this firm admitted to criminal wrongdoing. This is public. This is nothing I'm making up. They agreed to pay $456 million in fines and restitution and penalties to defer prosecution. And so when the Arizona Supreme Court is considering this, right, hopefully they're looking into this and any other numbers of circumstances, including with the Security and Exchange Commission. There's another one in 2003 with a Xerox audit settlement where KPMG agreed to pay over $22 million to the SEC related to its audits of Xerox Corporation for a number of years. And these are just two of multiple examples that are out there. And so if I want to become a lawyer in another state, one of the things that I have to do is say, hey, have I ever gotten in trouble before, right? Is there anything that I've ever done from a professional standpoint? And they look at it with a fine-tooth comb, right? Very, very closely. So it'll be interesting to see whether or not this application gets approved by the Arizona Supreme Court, whether they're going to be asking the right questions to see, hey, do we want an entity that's already been busted in numerous countries and settled, millions and millions of dollars of lawsuits that were brought against it for its alleged improper behavior?
Yeah, I mean, and just to give you a sense of it, Jeff, I think it in the middle of December last year, KPMG issued an announcement that indicated that its international global revenues were in excess of $38 billion. I mean, this gives you a sense of the types of entities that are looking to size and structure $38 billion of annual revenue, looking to involve itself with an alternative business structure out of Arizona. So evidently, there must be some opportunities there that they see that are not within their current portfolio of services and products.
So a lot to digest. And when I'm listening to this, I'm familiar with the lead gen world, LeadsCon, lead gen world, Contact.io. I frequent all three events, and there's a lot of people who are in the business of generating leads and sell them to the attorney world. But what they have always done is done it on a flat fee where they invest their own money at the cost to generate these leads. And then they get paid when a lead is sold. And when you have private equity or hedge fund investing on the lead gen side and investing on the attorney side and giving them a lot more money, you can definitely increase the lead gen speed and volume by a lot.
Correct. And a lot of the actions taken by the lead generators, unfortunately, do not comply with the lawyer's advertising rules, which is actually in Rule 7 of the Rules of
Yeah.
Professional Conduct. Now, this changes from state to state, right? In some states, it's actually criminal to violate those statutes in order to sign people up. But the receipt of text messages, I mean, the whole idea, we complain about the law firms that advertise on billboards all day long, or the people that dominate the commercials on late night TV, right? But the reason that you see that is because the way that the system is set up as supposed to work is that you make your advertisement as a lawyer and someone calls you, right? The whole idea is that we're not supposed to knock on doors or call you 3 days after a car accident when you're at your most vulnerable, or approach you during or right after a horrible, property loss event, right? And come and knock on your door and sign you up. The whole idea is that if someone feels that they need a lawyer, that they can call a lawyer, right? And what
Yeah.
ends up happening with these lead generation services, right, is that they flip that on its head, where they reach out to you via text message or your Facebook ads that don't follow any of the lawyer advertising rules. And here's the kicker: they can't get in trouble or get punished because there's nothing illegal or improper for what they do. Only the attorney can get punished. And so when you go to the State Bar Association or insurance commissioners, they go, well, I don't regulate that. And they know
Yeah.
this. They know that
And
the holes that are in the system.
and you have to dig through it, right? Like that text message, you have to dig through with your professional understanding of how everything work. You have to dig through who's behind that lead and where that lead gets sold to. A regular consumer never find it. And on top of that, if you do want to hold someone accountable, let's just say even for TCPA violations,
Mhm.
that could be offshore, overseas in India, in Pakistan, in Vietnam, right? Then the money's there,
Mhm.
the money go offshore. The team that represent those text messages are offshore, so they
Mhm.
literally play with no rules and regulation at all.
100%. The country where the text message that I received was originated from was Mexico. The call center people were based out of the Philippines. You're exactly
Yeah.
right.
And on top of that, today, with the development of AI, you have a lot of very successful AI agent company that play in the insurance world, and I am 100% sure if they play in the insurance world, they play in the legal world. You have these AI agents now masking their voice, no accent compared to an offshore call center team,
Mm.
right? And then they can dial at 10 to 20 times faster with the dialers that's available these days. And these AI agents now get on the phone and texting and calling and email. You have a speed to produce leads to these attorney firms at incredible speed. On top of that, this attorney firm with the support advisory of these alternative business or KPMG, they can probably successfully use more AI tools to have AI agent do paralegal work.
Right, and what we've seen, Jeff, and I think you've really pointed out a good thing. You know, the general conversation that has taken place over decades is that, hey, we're representing the little guy, and we need to have so much more resources to take on the big multi-billion-dollar insurance
Yeah,
companies. And now we're seeing a circumstance where the people who are coming after the insurance companies are actually more well-financed than the insurance companies themselves. Have bigger
yeah,
tools, have bigger investment budgets, even unlimited investment budgets with billions and billions of dollars that are being focused on attacking insurance companies and taking the money from those investors.
Well, I think going back, and Jeff, you make an excellent point too about speed to market. I mean, what's happened from my lay perspective, when you delete Rule 5.4D, parts 1, 2, and 3, the friction and the time of trying to properly coordinate a discussion about doing something and how to do it is now gone. You just can go directly to it because there's no more restrictions on how the non-lawyers can become involved. And that to me is where the litigation marketing and the money part of it now have become part of the initial conversation, could become part of the initial conversation with the law firms, because
yeah,
there's no more barriers to direct conversations and direct coordination of effort.
yeah. And we don't even know with KPMG's all the data that they're sitting on. They pretty much not just have data on their client, they have data against all the peers and competitor to their clients, I'm sure. And man, I'm just thinking like there's so many Pandora boxes that get open. And one of them I'm thinking about just something I recently saw last week. I actually posted on my LinkedIn that Morgan and Morgan is now advertising, hey, they're advertising on Facebook and other social media like Instagram, etc. Say, hey, have you been non-renewed by your insurance carrier? If you do, you might have a class action case or somehow, don't quote me, but it's somewhere in that language where they are fishing and hunting for their future clients through social media drops and advertisement, right? But just follow me here, okay? So now that if KPMG were any other auditing firm who want to come in here because KPMG opened the door for the other three big accounting firms to come back in, right? Then next thing that happens is all four accounting firms could do this, right? And they have the data on everybody. And with marketing, the easy thing about marketing is you can do filters. So I can easily do a campaign says, I'm targeting Allstate. I know what Allstate have on their balance reserve. I know how much Allstate pay in California for their own reinsurance. Because State Farm or Farmers is my friend in California, and I am gonna help my friend out to eliminate one of their competitors. They can easily do marketing strategies on really drum up all the claims against Allstate and nothing illegal about it because they are just fishing for customers and they're telling their marketing buyers where to fish. Now they're playing kingmakers.
Yep. Well, I'd like to read something also in there.
Is
There's
that
a
is that
company,
possible? What I just said? I mean, I know you're not
100%.
accusing anyone of doing
No,
it, but
It is possible. I mean, I think I'm sure they have an answer to that. KPMG has an answer to how they'll have some Chinese walls, but the reality is that's now something people can think about that they didn't have to think about prior to alternative business structures.
yeah,
yeah.
you can
Well,
see like one carrier frequency go sky high and the other three or four are not affected, or vice versa. Only one carrier is not affected, and the other all the competitor are affected.
no, no, correct. There's something that I'd like to turn both of you gentlemen onto. There's a company, it's called CRISP. It's based out of Georgia. And what they advertise themselves as they are recognized as the #1 law firm growth company in America. On their main website, they advertise unreasonable growth for uncompromising law firms. Right? That's what they advertise. Now, they have a whole coaching section that says what non-lawyer firm ownership will mean for your law firm. And so they're talking about the changes to Rule 5.4. And it says, as it stands currently, only lawyers can own law firms and even compete with other lawyers. And then this is their words, not mine. But once non-lawyers can start owning, operating, and fee sharing with law firms, seasoned business professionals, think Fortune 500 CEOs, venture capitalists, and hedge funds will start entering the scene. And so it says, with a little preparation, you can stay ahead of the curve and leverage these changes to the benefit of your law firm. And so from that standpoint, even somebody who talks about, massive growth for law firms is saying, look, here is a threat, right? But then also be the first to innovate, be the first ones to, to be able to get ready to compete, and also to treat your law firm not a business, like a business, excuse me, not like a law firm. And so that is what they're warning about, and actually even almost asking law firms to embrace the same approach that the non-attorneys are going to bring to the table, and that's highly concerning.
I think from an insurance industry perspective, and I'll take maybe a step back from the specifics of particular companies, but just going back to the alternative business structures and to comments like the ones that are on the CRISP website, the insurance industry, and I'm talking about, APCIA. I just read this month, January 2025, one of their initiatives is to make the disclosure of third-party litigation funding, make that an initiative. That's way too late. The horse is out of the barn. I mean, the problem we're having as an industry is everyone else who's an antagonist of the insurance industry is moving at warp speed, and we're still trying to put on our shoes to go race with them. That is what concerns me, and that's what I think is maybe, I don't know, Matthew, but I think that's the biggest takeaway from your podcast is we have to up our game in the insurance industry, because everyone else is bringing multi-billion-dollar companies to purchase law firms under changes in American Bar Association rules to come after us, and we're worried about the things that were important 5 years ago.
100%. The insurance industry has their proverbial head in the sand, and when you have your head in the sand, something else is exposed, and it's really bad. And this is and what we all know, right, is when you have people that are represented by counsel, right, that the claim costs go through the roof because you're paying for defense lawyers, you're paying for defense experts, you're paying for all of this. And the biggest challenge is that what we're seeing now that it's moving away from just the mass torts, from the Camp Lejeunes and into regular claims, from car accidents to slip and falls to anything else, for property cases as well, is that you're seeing a higher volume of represented cases, which is making things so much more expensive for insurance companies. And what do insurance companies do in response? They raise their rates, right, to address the higher costs that they're dealing with. And the big challenge that now is what we're getting to the point where the policyholders all around the country can no longer afford the rate increases. And the people who are standing to benefit from these changes to Rule 5.4 and the way that the system is going with the lead generators and the hedge funds, right, are the hedge funds, the law firms, the people who are involved in the fight. I'm a beneficiary of it, because when you have more lawsuits out there, you have more defense lawyers, have to be hired and make money. And it's getting to the point where it's literally unsustainable, the track that we're on.
Yeah, and I'll go back one step further. Jeff, you mentioned that you read something about, cancellations and non-renewals might become actionable. I mean, not even waiting for claims anymore. They're taking underwriting tools like cancellation and non-renewal. They're taking those and they're turning those against the insurance industry. You talk about everything that the insurance industry does. Now we're being attacked about our claims. There's litigation coming after claims, manufacturer claims. There's harvesting of claims. Now they're coming after us for doing what we do. We underwrite, we cancel, we non-renew. And now the very actions that we take on a regular basis are becoming actionable. We're totally being besieged, and we're worried about disclosure of third-party liability funding. No. That was 5 years ago, maybe 10. We have to get with the program and understand that it's an all-out battle. And no, we're using the Marquis de Queensberry rules, but we're in a street fight.
Right. One of the other things that came up just very recently, and it's very disturbing, there's another group called the Association of Professional Responsibility Lawyers. These are people who, have the whole basis is to ensure that the professional responsibility rules get followed, right? And then December 12th, 2024, the head of that organization, the president of that organization, Kendra Basner, wrote a letter to the president of the American Bar Association, right, imploring them to change Rule 5.4. Now, the American Bar Association doesn't speak to, doesn't regulate anything, right? But it certainly is an influential lobbying organization. Fortunately, laws are, in the legal field are handled on a state-by-state basis, right? But they said that they voted unanimously, their board, right, to indicate that there's a critical need for changes in this ethics rule to address the continued inevitable involvement of non-lawyers in legal delivery systems. That's a profound statement saying, hey, look, it's happening anyway, so let's just change the rules to allow it to happen. Let's change the ethical rules instead of enforce them.
And
to me,
how much
I can't
sooner
be.
before all the other states start coming in, right? Like right now, there's only 3 states.
There have been efforts, strong efforts in Florida, California, and every other state out there. There are strong efforts in place to lobby and to get those changes being made. Yes.
Well, I think the thing I think about, Jeff, is if you have Arizona, what happens if an Arizona law firm acquires a law firm in a different state? You can effectively have 50 law firms all owned by an Arizona law firm, and then that just complicates, what is the ethics that are applicable if your ultimate parent's in Arizona. I mean, there's just, things are changing. Things that have been in place for decades are changing by the minute, and we as an industry don't seem capable of keeping up. That's the dilemma I see, is everything in claims is changing. If the number of claims a company receives all go to litigated claims, you never have a non-litigated claim, there's not enough money in the world for
No.
insurance policies to be priced, for
Is
consumers to buy them.
is today this is happening in the property space, in the auto space. Where else is this happening in right now? Are we talking about every space like commercial, E&S, health, benefit?
I don't necessarily know that we've seen it in the health space in particular, right? But I have received the email, text messages, the people searching out, and they're talking about workers' comp. They're talking about, general liability. They're talking about, just anything that a property casualty world that is pretty much where it's been limited to. But why couldn't it also be applied to health and to other industries?
Health and benefits.
There was a case, workers' comp, there was a case in Florida this month where the statute of limitations for workers' comp claims was revisited by the very same court that supported it and left it the way it was a few years ago. So workers' comp in Florida may change as the statute of limitations becomes eliminated on certain workers' comp claims. These are smart people. We're up against, as an industry, we're up against very smart people that are fully funded. I mean, and when you superimpose artificial intelligence, they are light years ahead of us. These litigation platforms that have been in place that are being used to augment and harvest claims where there might not have been any, they've been in place since probably 2015. We're just starting to talk about AI in the industry, and the other side's been looking at it for 10 years. You're the IT guy, Jeff. You can only imagine what it'd be like to have a 10-year head start.
I've seen it. I have talked to many people who brag about it, and I can't share on this podcast. Maybe we'll have offline conversation, but like I don't need to picture it because I heard people brag to me about it.
Well, one of the systems that's in place for litigation management actually was created by John Morgan of Morgan & Morgan, Litify. They advertise to insurance companies, they advertise to insurance defense firms. It's a Salesforce-based platform, right? That, because Morgan & Morgan bragged last year of filing 37,000 lawsuits. They have 1,000 lawyers, over there, and they have this big national presence, and they are the biggest, plaintiffs firm in the world as they advertise. And so the existing systems couldn't even keep up for them, so they created their own. And that's what they're using, and that's what they're trying to actually get other insurance defense firms to use.
And that was bought by a private equity firm in early 2024. No, perhaps 2023. It was purchased by private Bessemer.
And
So let me ask you guys a question. Now let's put our creative hat on. If this is out there, this is coming. We already saw one comet coming. There's a bigger comet that's coming, colliding with us. What's the solution? What's the battle? We're now going to war with a bigger enemy. What can an insurance company do?
It's a very good question. They have to get beyond just raising rates, because they have to look at it and say, hey, look, what is right for the consumer, right? We're talking about, does everybody have the right to sue their insurance company if they feel they're unfairly treated? Absolutely, right? But it's getting past that. We need to make sure that we end that practice or require disclosure of, hey, lawyer, how did you obtain this client? Right? If we shine the light on these improper practices, it can go away. The problem is that our bar associations, even when you look at the disciplinary boards for the bar associations, they are way behind. They are understaffed. They are under-resourced. And again, no one can even imagine this stuff or even pretend that the stuff is happening. And so the insurance companies have to take a much more direct approach in determining what is going on. And actually, if you find some bad behavior, the insurance company should take affirmative steps to end it, whether it's filing complaints with bar associations, whether it's filing complaints with departments of insurance, or whether it's actually engaging in litigation with the people who are attacking them improperly and violating the laws that are in place. If we enforce the laws that are in place, most of this stuff would go away. The problem is most people can't see it because it's not on a billboard. Right? It's a text message that gets to somebody else. And so then when I, as a defense lawyer, ask the question in the deposition, well, how were you signed up? Objection, attorney-client privilege. Right? And there lies the problem. And so requiring disclosure of how they got the client and how they communicated with the client, I think would shine the light on it. But then even further, you have to have laws that almost make it criminal for the hedge fund themselves to invest in and to own law firms. You have to have the same statutes that kind of penalize the lawyers for doing bad behavior, engaging in this, for having people who work with lawyers, and basically have there be some sort of punishment there. For example, Texas has a law. Texas has a law that is called the Texas Civil Anti-Barratry Act, where if somebody is a victim of attorney solicitation in an improper manner, they can sue that law firm for $10,000. Each instance plus attorney's fees. That's an amazing tool that's been given to the public to protect themselves from bad attorney behavior. However, that law does not extend to the lead generators. That law does not extend to anybody else that works at the law firm. It doesn't extend to the hedge funds. So if we could pass a law like that in all 50 states and extend it to the bad players in the marketplace, then that could actually end this pretty quickly.
Yeah, I'll give you two thoughts on what companies can do. First one, and it sounds, first one's a long-term play. We have to get to the point where people trust insurance companies again. Maybe they trust them, period. Maybe they never did. But everything we're hearing, whether it's billboards or whether it's advertising, whether it's the online, it's all about the insurance company's going to screw you. The second, we have to figure out how to fix that. The second thing I would suggest is take more cases to trial. Make these guys lose, because every little win on the steps of the courthouse is another opportunity to drive claims of a similar nature because it was settled for X dollars. Take them to court and win, or take it to court and lose. But this idea that you somehow are saving money by getting ripped on cases that are marginal is, we have to figure out what to do. We have to figure those two things out. Better reputation, fight the ones that deserve to be fought.
So on that note, is there a business model that doesn't exist today that should exist today? So let me just play out a scenario. If the cat cannot go back into the bag, and we know that these lead gen world players are playing with all the local attorneys, local law firms, and they're now being part owners, and this is only going to go bigger. I mean, if we were about little lead gen shop based out of Mexico, what happens when Lending Tree, EverQuote, Alpha Media, Media Alpha, Queen Street, when these public traded lead gen companies start playing with all the Morgan out there, then this become even bigger problem. So can there be a solution we're birthing another company to combat that and fund all the defense attorneys across the country and give them more tools like AI tools to combat that? Does that make a difference? And how can we fund it?
I'm going to jump in first. I think one of the dilemmas we're running into is, I think the insurance industry would be concerned about antitrust issues if they work together, whereas for whatever reason, the teams on the other side of the insurance industry can collaborate as much as they like. As a matter of fact, all the deletions to Rule 5D,
we don't need insurance
facilitate
industry.
collaboration.
We don't need insurance industry to jump in. If we can say, hey, ABC hedge fund or ABC venture capital or ABC private equity, there's money to be made because insurance carrier needs help. And if we fund this ahead of time, we can go win cases, we can go battle cases, and we can get a lot more defense attorney on board to fight. Versus if we don't get a lot more defense attorney on board to fight for the insurance carrier, then insurance carrier are gonna just get overwhelmed, overcrowded, and they just say, you know what, we don't have enough resource to fight, we're just gonna cut checks, right? We don't have enough resource to fight, we cut checks, versus now we get more defense attorney employed on a future investment, and we're looking for future return. At the end of the day, you don't need insurance because everybody want to play, and we just gotta figure out a sandbox for people to say, hey, they figure out the sandbox to let everybody in. Now we need to figure out a sandbox to let everybody in.
No, certainly. One of the things that you bring up there, right, is that the financial incentives on the plaintiff side are so much greater than on the defense. The defense firms get to bill by the hours. What you actually have are a lot of entities that when we submit our bills to insurance companies, quite frankly, there's whole businesses that are aligned out there to cut the bills of defense attorneys. There's any number of defense attorneys that switch going over to the plaintiff side because they can make more money. And I'm not talking about just a few $1,000s more. I'm talking about hundreds of thousands, if not millions of more dollars being on the other side in the way that it's currently situated. And so from that standpoint, defense attorneys for decades now have been in this culture because judges don't want to try cases, right? Attorneys don't want to try cases. And so the whole things, even after the hurricanes, we had across the board in Louisiana, after the 2020-21 hurricanes, we had case management orders in which you as a defense attorney could not fight in the way that Joe was suggesting, that you had to provide your initial disclosures of, everybody show everybody what they have, and then go straight to a mediation, right? The judges did not want the fight. They did not want certain pleadings to be filed. When I started doing what we do after those storms, we were told by the courts, stop filing these motions. These are motions that have won time and time again. Hey, your job is to go into the settlement conference. We don't want this filed. So what we have is a legal system that is designed to just transfer money into the hands of these investors, and it's going to take a gargantuan effort, right, to have that take place. There's so many lawsuits that are in Florida that Florida finally just had new rules of civil procedure enacted this year to say no more continuances of trials for any reason. You have to go and here's your trial. And the courts and the attorneys are very stressed out and frustrated because they couldn't litigate everything, because if you file a motion, it might not get heard for 2 or 3 or 4 or 5 months. That's important to your case. And so it's a complete reworking of the industry because there's so many lawsuits that are out there in the system. So we either need more judges, more defense attorneys, or to be able to handle this influx, or to basically say, hey, look, let's shine the light on how you're signing these people up. So we can either, say that this change that's already in place is inevitable, and let's just open up Rule 5.4 and have every defense lawyer also owned by a hedge fund, right? And we're going to have hedge fund on one side versus hedge fund on the other side, or maybe the hedge fund owns both sides, right? Because they don't have any conflicts to worry about. It's a much larger problem than just creating an entity to go fight these lawsuits, because the courts will not let us process everything that we want to do as defense lawyers.
And there's a reason for that. I think when you think about it, that's the one thing that we didn't, when we're looking at the influx of litigation funding monies, and we're looking at the additional number of litigated claims that have really escalated over the last, say, 10 years, as an example. The judicial system is the same size it was. So what we have is a saturated judicial system, because the number of claims that they were used to moving through each year has increased rapidly as well. And so the infrastructure is fixed, but the number of claims has been skyrocketing. So that's problematic in and of itself. The second thing, to your point about monies and how could there be another firm that's attracted to the defense side, I think it was 2023, Bloomberg published its top 5 yielding investments of 2023. Number 1, litigation funding, outperformed everything. So how you attract—
What was the return?
I think it was like about 12.5%. And it outperformed everything else in the series of the top 5. But those returns were, 2 years ago, if it was 2023. But my point is, the judicial system is saturated, beyond saturated. The monies are going to pour in. And once again, it seems to me, with alternative business structures in place and growing, even if it's just Arizona for now, even though you got Utah and DC, you look at Arizona and the 40 or 60 that are approved there, others in process. Once again, the insurance industry is behind because the alternative business structures are there. They're accessible. They're beginning to define the rules of engagement, and we're chasing disclosures of third-party litigation funding. We're so behind. We have to somehow up our game and move quickly. And whether your solutions, Jeff, are the way they go, or whether there's other things to do, the point is the status quo is going to crush the insurance industry and the consumer, because the costs are just going to escalate.
One of the
I'm
things
reading
Go
the
ahead.
report Joe mentioned, and it says it's a $15 billion industry today.
I
And
can read
a
it.
lot of cases get settled later. So one case could be today, they just got involved, and it could be 3 years later that settlement come out. So what that number look like 3 years from now is a lot different. Sorry to cut you off, Matt. So go ahead.
I know I was interrupting you. I'm looking at an article written by Emily Siegel, and Emily Siegel's with Bloomberg Law. And her article was actually a little over a year ago, December 19th, 2023. And here's something else that when you talk about what are insurance companies doing about it, the title of the article is Insurers Invade Litigation Finance, Boosting Law Firm Options, meaning that some of the biggest insurance brokers in the world, Aon, CAC Specialty, and Willis Towers Watson, as she quoted, are invading the space of litigation financing. They're actually investing in it. When I came across this article, it was early September. I put a post on my LinkedIn saying, hey, look, here this is, because this is a direct conflict of interest by the insurance brokers, the people who are providing reinsurance that are out there. Aon came out 3 weeks after that and said, we're no longer involved in litigation finance space. I haven't seen any similar announcements from either CAC or Willis Towers Watson. But what they realize is that, wait, there's a great return on that investment, and that they can go ahead and with the money that they have access to all around the world, we can go ahead and actually provide that financing at a more reasonable rate of return than the hedge funds that were in the space to begin with. And so, I mean, there's a quote from the article that says there soon could come a time where insurance disrupts a meaningful portion of the legal finance market. And when I saw that, I was just blown away. And so one thing that actually has to be looked at is litigation finance part of an insurer's investment portfolio? Are they actually getting into the business themselves? I'm surprised that we haven't seen a larger, outrage from the insurers themselves. And this suggests a reason why we haven't seen that.
I think again we respond in sometimes exotic and eccentric ways. I mean, I think at one point we as an industry were selling judgment protection insurance, so that if you got a nuclear verdict and it was going to be appealed, you could actually buy insurance to say, well, you could buy a tenth of it, or you could buy coverage up to 20% of it, whatever it might be, to protect yourself against the judgment being reduced. And I also believe that those coverages have also been, I believe, suspended by the industry. But that being said, is we respond in unusual ways. Rather than addressing the issue, we kind of look to somehow maybe make some money off of it. But the litigation, the frequency of litigation versus 2025 versus what it was 10 years ago, if we don't get it under control, it will be consumers who ultimately suffer. They just can't afford insurance.
Right. And whether it's a Republican or Democrat issue here, it's of no moment, no matter what perspective you look at it. If you look at it from the the hardcore traditional Republican perspective, it's just bad business. It doesn't make any sense, right? But if you're looking at it from a much more liberal perspective, this is a classic circumstance of the 0.1% sticking it to the 99.9%. And the people who are suffering the most are poor, are minorities, are uneducated, the people who are the most vulnerable parts of our society. And it's just wrong. And the people who are making money off of it, right, is everyone involved in the fight. And so and I don't want to be part of that, which is why I'm happy to be here on this podcast with you, Jeff, and with Joe, because there's not enough people engaging in this conversation.
We usually have a recording, editing, and then it's on the shelf, and then the podcast drop. I'm gonna push this podcast drop to much, much earlier ahead of the line. And I'm hoping that people who listen to this podcast can reach out to, Matthew, yourself, and Joe, or myself, and maybe we can make this like a series of podcasts, and then we have other guests come on, share their story, tell their story, share their opinions, and we bring more visibility to this whole thing of alternative business structure directory of Arizona, of Utah, of DC, and then more people talk about a solution, because where we're going is almost like the apocalypse of the insurance system, the capitalism system that we have, right?
Yeah.
If anybody listened to this whole podcast, the past 54 minutes, they should understand the end is very ugly.
Right.
And right now, the amount of America that's uninsured, especially in the property segment, is higher than ever because people just can't afford it.
Right.
And Jeff, I would encourage you to do what you just said. And we'll Devil Tech will help you. I think it's important for the trade associations to understand that disclosure of third-party litigation funding is it's not they talk in I could talk in math terms of being necessary and sufficient. It might be necessary, but it's insufficient. We need to go well beyond those types of disclosures, and love to share some thoughts with the trade associations that are trying to help their members and consumers.
Yeah, and then just add maybe this is an area that Matthew and all your smart colleagues of defense attorney can think about. There got to be a way if the other side is bringing all the hedge fund and private equity guys in. There got to be another way for you guys to bring hedge fund and private equity guys in. And just hear me out for a second, right?
Mhm.
Allstate, Liberty Mutual, Nationwide, they non-renew a massive portion of their premiums in California. So those businesses of auto and home properties is all get picked up by regional carriers, state carriers, mutual carriers, and fair plans. And they don't have the resources of a national carriers has, like Liberty Mutual of the world, where they have tons of in-house attorney on the hook, right? So if the future of our insurance, Colorado, California, Texas, Florida, Louisiana, Michigan, South Carolina, these seven tough states where insurance is really difficult between properties and auto, then we are going to see a lot more regional, a lot more MGAs, a lot more insurtechs. And if we do create a equalizer of a company on this side, then we will have endless people raising their hands of customers ready to take on the service, if that makes sense.
It does, but think about what you just said. If the larger companies, the nationals, the brand names that everybody knows, if they're losing business and it's going to smaller companies, I respectfully submit that what's happening is the small companies that they're going to, the regionals, the ones that Demotech tends to look at, they're going to leave them alone because they are small and they're not the deep pocket. What they're going to do is, even though there's been cancellations and non-renewals, they're going to be looking for new ways to go after the big carriers because the big carriers have the deeper pockets. And that could be, and to go back to the beginning of this podcast, you stated it, they're now going after companies because they cancel and non-renew.
Yeah.
They're going
So
after,
so Ohio's the new
they're
battleground.
going after, well, they're going after the big ones for doing anything. So all of a sudden, it's become fashionable to become small because they'll leave you alone. And if you're big, they'll find new ways to come after you. It truly is something that the trade associations have to figure out. This is truly four-dimensional chess, and we're playing checkers.
And when you say trade association, one thing about insurance associations is everybody play in their own lane. They're not really as a united front.
Let's find a way. Let's use your podcast.
We are gonna have a couple more series on this for sure, and I'm sure people should be reaching out to us after they listen to this one because we gotta find a way. Matthew, any closing message?
I just want to thank you guys for letting me be part of this. What I think is the most existentially important conversation that needs to take place and is not taking place in our industry today. And so, I thank you for your platform. I thank you for your interest in this. And again, my perspectives are not coming from the fact that I represent insurance companies, right? No one feels sorry for the insurance companies. This is hurting policyholders. There's people who simply can't afford the coverage that they desperately need for their lives.
I think my closing comments, I mean, when you look around the screen, you got Matthew understands the law and the defense of insurance companies. You understand how technology can be leveraged. and how lead generation and all these other things can become a fulcrum. And I'm looking at it from the actuarial perspective, exactly what Matthew said. People can't afford it, companies can't afford it. It's impacting profitability of bigger companies. It can take down smaller companies. I mean, we need to have greater conversations, more in depth and more of them, and we gotta get started soon.
Yeah. So thank you, audience, to listen to this. Make sure you guys subscribe to us, and make sure you guys go follow Matthew Monson. We're gonna put a link to his LinkedIn in the comment section below, and also Joe. Make sure you follow Joe and his company. So thank you very much, and we'll be back with another episode very soon.
Thank you so much.
Thank you.